Welcome to our deep dive. You've handed us Warren Buffett's letter to Berkshire Hathaway shareholders from 1996.
Oh, wow.
Yeah, back in the days of dial-up internet and, floppy disks.
Yeah.
So we're going to kind of rewind back to 1996 and see what made that year so remarkable for Berkshire, explore Buffett's investment philosophy and hopefully uncover some timeless wisdom that's still relevant today, even in 2025.
Right. And what's interesting is that 1996 was a year of significant growth for Berkshire. Their net worth shot up by an impressive 36.1%.
Whoa.
To understand how they achieved this, we'll need to unpack Buffett's approach to investing, particularly his focus on what he calls intrinsic value.
Okay, let's unpack that. Intrinsic value sounds pretty straightforward, the inherent worth of something.
Right.
But how does Buffett actually use this concept in his investment decisions?
Well,
What does it even mean in practice?
for Buffett, intrinsic value goes beyond just looking at the stock price. It's about understanding the true earning power of a business, its competitive advantages, its long-term prospects, and its ability to generate cash flow over time.
So it's like peering beneath the hood of a car to see what's really driving its performance, not just looking at the, shiny paint job.
Exact.
Now, Buffett made some pretty significant moves in 1996, right?
Yeah.
He closed two major acquisitions, Kansas Bankers, Surety, and Flight Safety International. But what's intriguing is that these deals weren't the result of some, high-powered boardroom negotiations.
Exactly. The acquisition of Kansas Bankers, Surety, or KBS, happened through a chance encounter at a birthday party.
What?
Yeah.
Really?
Buffett was seated next to Roy Dinsdale, whose company owned KBS, and casually mentioned his interest. Weeks later, a deal was struck.
Wow, talk about being in the right place at the right time.
Right.
So it really highlights Buffett's opportunistic approach
Yeah.
and his ability to build relationships that translate into valuable deals. And the Flight Safety International deal was even more unusual, right?
Absolutely. A flight safety shareholder, Richard Surser, actually initiated this one.
Oh, wow.
Seeing the potential synergy with Berkshire, he suggested the deal, essentially playing matchmaker.
Wow, so valuable insights can come from unexpected places.
That's right.
It seems like Buffett has a knack for turning casual conversations into billion-dollar deals. But what really stands out to me is that in both acquisitions, he was adamant about retaining the existing management teams.
Yeah.
It suggests a deep trust in experienced leadership, doesn't it?
Precisely. Buffett consistently emphasizes the importance of skilled managers who truly understand their businesses. He sees them as partners, not just employees.
Right.
This approach is also reflected in how he structured compensation at Geico, another key piece of Berkshire's success story in 1996.
Geico. They were already a star performer back then, and they've only grown stronger since.
Right.
But what fueled their remarkable success in 1996? Was it a groundbreaking marketing campaign, a revolutionary new product?
It's not quite. Geico's success boils down to a surprisingly simple idea: low costs.
Okay.
Their efficient operations and streamlined processes allow them to offer lower prices, attracting and retaining good customers who then recommend them to others.
So it's like a ripple effect.
It's a classic example of a virtuous cycle in action.
So it's not about flashy gimmicks, but about solid fundamentals.
Right.
Keeping costs low, offering competitive pricing, and building customer loyalty.
Yeah,
It seems almost too simple, yet it's clearly a winning formula.
it is.
And Buffett further solidified this focus by implementing a new compensation plan at Geico. Instead of relying on complicated metrics or stock options, the plan centered on just two key factors:
Wow.
growth in voluntary policies and underwriting profitability.
Right.
So he's tying compensation directly to the factors that drive long-term value creation.
Yeah.
It seems like a pretty straightforward way to ensure everyone's rowing in the same direction.
Exactly. It reinforces the idea that sustainable success isn't built on short-term gains or market manipulation, but on a deep understanding of what truly creates value.
And now we can't talk about Berkshire's success in 1996 without diving into their insurance operations. This is where things get interesting, especially when we consider the concept of float. It's often considered a key ingredient in Berkshire's secret sauce, but to be honest, it can be a bit of a head-scratcher.
You're right. Float can be a bit confusing. Think of it like this. When you pay your insurance premium, that money doesn't immediately go towards covering a potential claim.
Okay.
It's held by the insurance company, and they get to invest it and earn returns until a claim needs to be paid out. That pool of money they're holding, that's the float.
So it's essentially free money that Berkshire can use to fuel their investments, right?
In a way, yes. And what's remarkable is that Berkshire has consistently grown this float at an impressive rate, compounding at 22.3% annually since 1967.
Wow.
It's like having a giant snowball that keeps getting bigger and bigger as it rolls downhill.
Yeah, that's an incredibly powerful advantage. And in 1996, they took it a step further by venturing into super cat insurance, which is insuring against mega catastrophes like hurricanes and earthquakes.
Yeah.
It seems like a risky game, doesn't it?
It certainly does. And Buffett acknowledges this, stating that in the super cat business, a terrible year isn't a possibility, it's a certainty.
Oh.
But he also emphasizes that Berkshire can handle these big hits. They structure their deals carefully, ensuring they can weather even the most devastating storms.
It's about calculated risk-taking. They're not just throwing money at every disaster that comes along.
Right.
They're strategically choosing which risks to underwrite, based on a deep understanding of the potential downsides.
Exactly. And this strategic approach is evident in two major deals they made in 1996.
Okay.
A hurricane contract with Allstate in Florida and a massive earthquake policy in California. They were essentially betting on the fact that most years would be profitable, even with the certainty of a huge loss at some point.
That's a pretty bold move, but it seems to be working for them. So we've got smart acquisitions, a booming insurance operation fueled by the power of float, and a management philosophy that emphasizes trust and long-term thinking.
Right.
It's starting to paint a pretty clear picture of how Berkshire achieved such impressive growth in 1996.
Yes, and to fully grasp the magnitude of their success, we need to delve into Buffett's investment portfolio. And a key concept he highlights in this letter, look-through earnings.
Okay.
This will help us understand how he views Berkshire's true earning power beyond just their operating income.
Okay, this sounds like a fascinating piece of the puzzle. I'm ready to dive into look-through earnings and see what other gems we can uncover about Buffett's investment approach.
Let's do it. Look-through earnings is a fascinating concept. It basically means looking beyond the dividends Berkshire receives from their investments and considering the retained earnings of their major holdings.
So instead of just focusing on the cash coming in, Buffett is also factoring in the earnings that are being plowed back into those businesses, essentially capturing a more complete picture of Berkshire's growth.
Exactly. And in 1996, some of their major holdings included iconic names like American Express, Coca-Cola, Disney, Gillette McDonald's, and Wells Fargo.
Wow.
This wasn't just a collection of stocks. It was a carefully curated portfolio of companies that Buffett believed had a durable competitive advantage and significant growth potential.
He refers to some of these companies as the inevitables, right?
Yes.
These are the businesses that seem almost destined to succeed, almost like owning a piece of the future.
Precisely. These are companies with strong brands, efficient operations, and a knack for consistently delivering value to their customers. Buffett compares owning these companies to owning a piece of the future earnings of talented basketball players.
So even if the market goes through ups and downs, the inevitables are likely to keep performing well over the long term. It's like betting on the all-star team. Sure, some players might have an off-season, but the team as a whole is likely to keep winning.
And Buffett even shares a delightful anecdote about Coca-Cola in this letter. He was reading their 1896 annual report.
Wow, going way back.
And noticed how their blueprint for success was evident even back then. Their president at the time was boasting about their global ambitions and their ability to connect with consumers around the world.
Over a century later, Coke is still using the same playbook.
Right.
It's a powerful testament to the enduring strength of a well-managed brand and a product that resonates with people across cultures.
It also highlights the importance of understanding a company's history and its core drivers of success. Buffett isn't just looking at the current financials. He's digging deep into the DNA of the business to see what makes it tick.
But even with the inevitables, Buffett emphasizes that execution matters. He points out that both Coke and Gillette made some costly mistakes in the past by venturing into areas outside their core expertise.
Yeah.
It seems like a reminder that even the best companies can stumble if they lose focus.
Absolutely. It reinforces the importance of sticking to your knitting, staying disciplined, and focusing on what you do best.
And this leads to a crucial question that Buffett addresses in this letter. How should individual investors approach the market?
Yeah.
He acknowledges that most people are better off with low-cost index funds, which is a pretty humble statement coming from someone considered one of the greatest investors of all time.
It speaks to his honesty and his understanding that picking individual stocks isn't for everyone. It requires time research and a willingness to weather market fluctuations.
But for those who do choose to pick stocks, he outlines some pretty clear principles, right?
Yes. He advises focusing on just a few companies within your circle of competence, those businesses you truly understand.
Okay.
He emphasizes the importance of being able to value a business and think critically about market prices, not just blindly following the crowd.
So it's not about trying to outsmart the market or find some hidden gem. It's about developing a deep understanding of a few select companies and making informed decisions based on that knowledge.
Right.
And perhaps most importantly, he suggests owning a stock for at least 10 years, or not at all. This long-term perspective is at the heart of his investment philosophy.
It seems like he's advocating for a patient and disciplined approach, focusing on the long-term potential of a business rather than getting caught up in short-term market noise.
Exactly. And this approach is reflected in Berkshire's own portfolio. They hold many of their investments for years, sometimes even decades, allowing the power of compounding to work its magic.
Now, we all know that Buffett has a remarkable track record, but he's not afraid to admit his mistakes.
Right.
In this letter, he openly discusses his investment in U.S. Air, a decision he calls both superficial and wrong.
It's fascinating to see how he dissects this misstep. He was initially drawn to U.S. Air's long history of profitability and the perceived safety of their preferred stock. However, he overlooked a crucial factor, the deregulation of the airline industry. He basically admits that he was blinded by the company's past performance and failed to fully appreciate the changing dynamics of the industry. It seems like a reminder that even the best investors can fall prey to cognitive biases and make costly mistakes.
Absolutely. And what makes this even more valuable is that he doesn't shy away from dissecting his errors. He's willing to learn from his mistakes and openly share those lessons with his shareholders.
And despite the airline's struggles, Buffett was able to eventually recover his investment thanks to a shrewdly negotiated clause in the preferred stock agreement.
This penalty dividend clause essentially penalized U.S. Air for not paying dividends, allowing Buffett to eventually recoup his investment. It demonstrates his ability to protect Berkshire's interest even when a bet goes sour.
So it's not just about picking winners, it's also about having a plan B and being able to navigate challenging situations. But beyond the financial analysis and investment strategies, this letter also offers a glimpse into the Berkshire way, their culture, their values, and their unique approach to doing business.
One thing that stands out is Buffett's pride in Berkshire's significant tax contribution. He mentions that they paid $860 million in income taxes in 1996.
Wow.
He sees this not as a burden, but as a reflection of their success and their responsibility to society.
He even quips that if 2,000 other taxpayers contributed the same amount, the U.S. budget would be balanced.
Yeah.
It's a striking statement that highlights his belief in paying their fair share.
And it speaks to his broader worldview that businesses have a responsibility not just to their shareholders, but to the communities they operate in and to society as a whole.
It's a refreshing perspective, especially in a time when many companies are focused on minimizing their tax burden.
Another interesting aspect is their move to the internet. They were starting to publish their quarterly and annual reports online, acknowledging that not all shareholders might have computers, but embracing the digital revolution nonetheless.
He even invites feedback from shareholders on their preference for receiving physical copies. It's a reminder that he values shareholder input and is constantly seeking ways to improve communication.
And then there's their shareholder designated contributions program, which allows shareholders to direct a portion of Berkshire's charitable giving.
Okay.
In 1996, they had a 97.2% participation rate, with $13.3 million donated to over 910 charities.
That's a pretty incredible demonstration of shareholder engagement and a testament to their belief in giving back to the community.
And of course, we can't forget about the legendary Berkshire Hathaway annual meeting. In 1996, they were expecting a record crowd, prompting them to move the meeting to the larger Exarban Coliseum.
Wow, it's become a pilgrimage for investors from around the world, eager to hear directly from Buffett and Munger. They even plan pre-meeting activities like a Berkshire movie and opportunities to purchase Berkshire products.
It's a fun and engaging way to connect with shareholders and celebrate the Berkshire family. And of course, GEICO representatives were on hand, ready to help anyone looking to save money on their car insurance.
Always the businessman. So in 1996, Berkshire was firing on all cylinders, closing deals, generating strong insurance results, growing their investment portfolio, and fostering a thriving shareholder community. This letter gives us a fascinating peek behind the curtain, revealing the factors that contributed to their remarkable success.
But beyond the financial achievements, what truly stands out is the Berkshire way, their commitment to integrity, their long-term vision, and their belief in building a business that benefits not just shareholders, but society as a whole.
It's a reminder that business can be a force for good, and that ethical conduct isn't just morally right, it's also good business.
And as we move into the final part of our deep dive, let's see how these principles play out in the context of the broader market environment. Remember, this letter was written during a time of incredible economic optimism. The dot-com boom was just starting to gain momentum.
It will be interesting to see how Buffett navigated this period of rapid technological change and market exuberance. Did he jump on the tech bandwagon, or did he stick to his tried-and-true principles?
It's fascinating to see how Buffett approached the burgeoning tech boom while he acknowledged the potential of the internet. He even mentions Berkshire's move online in this very letter. He didn't get swept up in the euphoria surrounding tech stocks.
Right.
This is where his discipline and independent thinking truly shine. While many investors were chasing the latest hot tech IPO, Buffett stuck to his principles, focusing on businesses he understood and that he believed had a durable competitive advantage, regardless of whether they were tech-driven or not.
So he didn't completely dismiss the tech sector,
Right.
but he remained cautious, applying the same rigorous standards to tech companies as he did to any other investment opportunity.
Exactly.
Oh.
And this measured approach likely saved him from some painful losses when the dot-com bubble officially burst.
Makes sense.
It's a valuable reminder that even in a rapidly changing market, sticking to sound investment principles is crucial.
He also addresses the risk of overpaying in an overheated market.
Yeah.
He cautions investors that even if they buy a great company at an inflated price, it might take a long time for the value to catch up.
Right. It's like he compares it to buying a wonderful farm. You wouldn't expect to get rich quick.
Yeah.
You'd need to wait for the crops to grow.
Right.
It's a powerful analogy that highlights the importance of patience and long-term thinking.
I like that analogy. It's easy to get caught up in the excitement of a bull market and start chasing returns.
Yeah.
But Buffett's letter is a reminder to stay grounded, focus on the fundamentals, and avoid making impulsive decisions.
And his insights into risk management are particularly relevant today.
Okay.
He emphasizes the importance of owning companies with a strong moat, a durable competitive advantage that protects them from competitors and economic downturns.
So like a castle.
Yes, exactly the moat around it.
He also advocates for diversification, not just for the sake of spreading risk, but for owning a meaningful stake in a handful of great businesses across different sectors.
So not putting all your eggs in one basket.
Precisely.
It's about owning pieces of businesses you understand and believe in,
Yeah.
not just blindly following the crowd or trying to time the market.
That's right.
So this letter isn't just a historical artifact. It's a treasure trove of timeless wisdom that can guide investors even in today's complex market.
What strikes me is how Buffett manages to convey these complex ideas in a clear and engaging way. He avoids jargon and uses relatable analogies to explain his investment philosophy.
He's a master storyteller. He weaves in personal anecdotes, historical insights, and even a bit of humor to make his points come alive. He makes finance accessible and even entertaining.
This letter is a testament to his belief in transparency and open communication with shareholders.
Right.
He's not just reporting the numbers, he's sharing his thought process, his values, and his vision for the future of Berkshire Hathaway.
And that's what makes this deep dive so rewarding. We've gone beyond the balance sheets and financial statements to understand the mind of one of the greatest investors of all time.
Absolutely.
We've uncovered valuable insights into his approach to deal-making, his assessment of risk, his philosophy of leadership, and his unwavering commitment to ethical conduct.
Couldn't have said it better myself. So as we wrap up, I'm curious to hear what resonated most with you from this deep dive into Warren Buffett's 1996 letter to Berkshire Hathaway shareholders.
For me, it's the reminder that successful investing isn't about complex algorithms or insider information. It's about having a sound framework for decision-making, staying disciplined, and focusing on the long term.
Yeah.
Buffett's approach is a testament to the power of simplicity and common sense. What about you?
I'm struck by his unwavering commitment to his core principles, even in the face of a rapidly changing market. He didn't get swept up in the tech hype. He stuck to his guns and continued to invest in businesses he understood and believed in. It's a powerful lesson in staying true to yourself and your vision, even when the world around you seems to be going crazy.
It's a reminder that true success isn't about chasing the latest trend or trying to time the market. It's about building something lasting, something that creates value not just for yourself, but for others as well. That's a legacy worth striving for.
Well said. Thanks for joining us on this deep dive. We hope you've gained some valuable insights and a renewed appreciation for the enduring wisdom of Warren Buffett.
And we encourage you to continue exploring. There's a wealth of knowledge to be gained from his writings and his remarkable journey as an investor and a businessman.
Until next time, happy investing.